At the end of the day, we're going to recognize a $60,000 gross profit on the deal, and we didn't have to do all the work to recognize it. So the numbers to me are great. You make money up front when you buy it, you make money during the term. The buyer ultimately pays the loan that we have back, and we have a nice little spread at the back of the deal, so we'll pick up another nice check along the way. Most people don't look at it, don't think about it, don't know that it even exists, but I got to say it again. I know you guys at VIP Michael have done a lot of videos on the HELOC and how to utilize your home equity line of credit for opportunities to buy other investment properties, right? It's the same thing.
Welcome to the VIP Financial Education YouTube channel. I'm your host, Michael Maffey. Hey guys, we've got a great video today dealing with real estate investing. I'm talking more and more about different types of creative real estate investing strategies so you can become that true transaction engineer, meaning any deal that comes across your desk, you're going to be able to take it down. In this series, we're going to feature unique deals, dissecting them, creative deals each and every month. These are real deals and closings. So not only will we be able to show you the math and the ROI, but we're going to be able to break down the approach, where the lead came from, ultimately how you bring that deal to a closing. Now, the devil's in the details, and without knowing exactly what you're doing, it's very easy to make mistakes. We're going to give you the tools necessary to find, analyze, and do these deals yourself. Now, we've had Scott here on the channel before. He's going to be our special guest today. He's the founder of Little Pink Houses of America. We're going to dissect one creative deal each and every month with Scott doing it on the whiteboard. We call him a whiteboard ninja. He's as good as it gets. And I'm going to have Scott give you a little bit of his brief background. Guys, if you are still interested in Little Pink Houses of America, who he really pioneered that business model, we're going to drop a playlist below. Those are creative strategies that in many cases don't require cash or credit. The deal today does, however. Today, what we're going to be talking about is what we call an OverFi, or an overfinance deal. With that being said, Mr. Scott Ulmer, founder of Little Pink Houses of America, welcome.
Thank you, thank you. Glad to be here. Appreciate the opportunity, and I like that whiteboard ninja thing, man. That might stick. That might stick. So
you can go ahead and you can trademark that.
There you go. So I'm kind of a real estate, a cradle real estate guy. I've been around real estate my whole life. Actually bought my first house at 14 years old, and there's a story behind it, of course. I had a lot of help, but it was my first foray into real estate. And so fast forward the tape, I did a lot of deals through high school, or some deals, maybe a better way to say it, and through college especially, and ultimately started buying houses for my father's company, and we were very much a volume-based background. We were buying for cash in many cases. We're really buying everything we get our hands on. We're doing about 150 of these deals every single year. So I've got a lot of deals under my belt, really because I did a bunch in my early days because of the volume that we did at that time. A guy named Ron LeGrand, kind of the guru of gurus, brought me down, and I ended up running his real estate operation and did a lot of his high-level coaching for a handful of years, and then ultimately branched out to start Little Pink Houses of America. And so, and our intent really is to be able to replicate our model in other markets around the country, and we've had a lot of fun doing that. But I've got about 3,000 deals under my belt. You kind of stop counting at a certain point. I've certainly worked with a lot of folks to help do their deals as well, but that's kind of my experience in my 26th year doing this, and that starts after college, by the way, so I'm kind of dating myself a bit, but 26 year full-time, and man, loving every minute of it. So it's a lot of fun. It's a great business. It's the only business I know of that you can make a lot of money very quickly. It has big paydays, and certainly the opportunity to really change your financial life. So real estate's been a huge blessing. It's been the career path that I've been on, and will be my life's work. So I'm a real estate guy through and through, and like I said, certainly glad to be here.
So we're going to talk about a deal today called an OverFi, overfinance. Now, we did the video for subject 2. This is another very little known strategy. If you can kind of talk about, just from a 30,000 foot view, what this deal looks like. Obviously, we're going to go and dive in and really talk about the nuts and the bolts and the nitty gritty, where the lead came from, all the way, kind of that soup to nuts approach. But 30,000 feet, what is an OverFi?
Yeah, so overfinancing is essentially capitalizing on the equity that you have when you buy an investment property. So I would define an investment property typically as something that's distressed. And in this case, it was physically distressed, meaning it needed work, needed a fair amount of work. So when a house needs work, you're typically going to make a buy that factors in the work that has to be done. And so there's equity built in right up front. Overfinancing is essentially borrowing a little bit more than you need for the cost of acquisition and the cost of renovation. and ultimately putting that money in your pocket. And so it's something that I've been exposed to for a long time. It's kind of a little known strategy, if you will, but in fact, back in the days prior to me even starting, there was a phrase, buy a house, get a check, and that always stuck with me. And so what happens in an overfinance, Michael, is that when you actually go to purchase the house, when you're buying the house, you're actually getting a nice check right at that time. So you're getting paid right up front. And as you'll see when we go through the deal, you're going to get paid along the way and then ultimately get paid at the back end of the deal, and I'll explain what that means. But overfinancing, simply put, 30,000-foot flyover is borrowing a little more than you need for the cost of acquisition, the cost of renovation, and putting that money in your pocket. And especially when you have a deal that has some good equity, there's really some room in there to borrow a little more. In fact, I'll make it analogous to a HELOC or home equity line of credit, where it's really no different. In fact, it's the exact same. You're borrowing or utilizing the equity in the property to borrow additional funds that you can then use to go buy another property. You can take that, put it as a down payment, another property, put it in the HIP National Bank, or do with it what you like. So that really is the 30,000-foot flyover for what we define as overfinance or OverFi.
Yeah, we all love the HIP National Bank, guys, and that just means the money is going in your hip pocket. So you're over borrowing on the subject property. So safe to assume that institutional money is not in play here. They're certainly not going to lend on, higher than appraised value. They're not going to give you, kind of a rehab capital. What other avenues are you, or what would you recommend from a financing standpoint? And then we'll dive into the deal itself, just so people know from the outset, when they do come across these deals, kind of what that next step would look like.
Yeah, it's very, very astute. And I was going to say it's really spot on, because what it's not for, what you cannot really use the strategy for, is dealing with an institutional lender. Certainly a Bank of America, Chase, Wells Fargo, or a hard money lender would even be a little bit more difficult. And certainly I don't really advise borrowing hard money if you can avoid it. It's costly, a lot of points, and ultimately can be a deal killer, really kill your numbers if you're not careful. And the kind of secondary type lenders, mortgage brokers, mortgage lenders, it's the same thing. Those types of loans are only going to lend on the purchase price or the acquisition price, and in some cases you'll be able to borrow renovation costs depending on who the lender is. You will not, however, with all of those I just listed, be able to do the overfinancing strategy. So overfinancing or OverFi really comes from a private lender. So private investing is really one of the starting points if you want to get into real estate and buying them for cash and doing fix and flips. You need to take title when you're putting money into a property. That's one thing I learned a long time ago. So we control a lot of properties with contracts, but we don't put a lot of money into those properties because we don't have the actual deed. In this case, when you're doing an overfinance, you will actually own the property, you have the deed, and therefore you have the justification for putting money in. Real estate 101, you always use OPM, other people's money. It's taught that early on. You don't put your own money in deals, you borrow from other sources. So in this case, we had a private loan on the property, and when you have a private loan, you have a relationship with your private lender. They understand that you obviously are borrowing acquisition and rehab, and how we kind of framed the loan and what we needed was really to do virtually a full rehab with the hope that we would sell it without having to do a full rehab. And again, I'll explain that when we get into the merits of the deal, but to be specific about the question is that, yeah, you need to have, this is only really done when you have a private lender making the loan on the property.
Yeah, no, well put, and thanks for that explanation there, guys. And the audience looking, watching this video, did a video last week where we're talking about things that we're bringing here on the channel in 2022. They're going to be unique, going to be tremendous resources here for our audience. One is going to be, of course, Scott, breaking down these creative deals, turning people onto them. There's going to be a lot of these deals that most people have never even heard of unless they've been, really an investment pro for a number of years. So we really appreciate that. Also, he talked on private lending, just kind of a little teaser here for an upcoming video. We are going to be bringing a private lender here on the channel that you guys will all have direct access to. So we have gone out and have established a relationship on behalf of our audience here that you guys can plug right into. So stay tuned for that. And Scott, appreciate the backfill on that. So let's go ahead and dive into the deal here. And it's my understanding this is a $60,000 total deal. I mean, it's a 60 pounder is what we call them.
Yeah, 60 pounder. Yeah, that was not a bad one. We'll take as many of those as we can get.
Yeah, no, absolutely. So let's talk about the deal from the inception. How'd you come across the lead? And let's kind of just start there. And if you could just walk through the steps after the fact, and I'll just kind of interject with some questions along the way.
Fantastic, fantastic. And I've got it kind of laid out here, hopefully in a very easy to follow chronology. So the lead source and where the lead comes from, you really make your money in the buy. Let me say that again. You make your money in real estate when you buy the property because you're buying the equity when you're making these types of purchases. And so where the lead came from actually came right through our system. This was actually a for sale by owner, believe it or not. Now it needed some work. So that was really clear in the comments of the Zillow listing that we found. We called on it, and ultimately we kind of felt the seller out. What's their motivation for selling? Ultimately, what did the property need? How did they come up with their numbers? We have some very basic questions that we ask. I'm always interested in the backstory of the seller. What's the motivation? In fact, as we have some folks here that we work with, and one of them put this deal together, we've got a couple others in the queue right now very similar to this. First question I always ask is, what's the motivation? Why is the seller selling? That tells me so much. And one of the things I learned about motivation a long time ago, don't try to figure out what motivates people at the time. People make decisions at certain points in their life that are the best for them at that time. You may never do something like that. You may never sell at a certain price or make a decision that some of the sellers that we work with ultimately make. Don't question that. Their motivation at the time is what makes sense for them. So this was a property. It was bought as an investment, was rented out for many, many years. Tenants tore it up a little bit. No concrete in the toilets or any graffiti on the walls, but you could tell it's been lived in and certainly needed a pretty substantial amount of work. So we called on it and kind of felt the seller out. And one of the things that we like to do, Michael, when we have a property that kind of fits this description, needs some work and certainly has some equity built in because of it, is we like to make multiple offers. It's what we call MOS or multiple offer strategy, where really we'll make a cash offer and a terms offer, where essentially we'll agree to buy it on payments. And so seller was originally asking $165 for the property, and when we got there, took a look through, we made an offer for cash at $125 and an offer to buy it on terms for $150. So obviously the cash offer is always going to be lower. Terms offer is going to be higher because you're not paying it today. Cash is king. So if you can get a terms deal, I've always said you have the ability to pay a little bit more because you're not paying it today. And there's obviously a value in having cash and actually having to deploy the cash. So originally seller took the $150 on the offer. And I found that to be the case in many cases. They'll take the higher number for fairly obvious reasons. Well, 9 days later, we get a call from the seller, had a life change in his world, and said, is that cash offer still available? So we said, yes, it is. And we ultimately negotiated the $125 up to $130. So I'll just start over on this side here. So we paid $130 for the property. So that was our acquisition cost. And we've already closed it. And I'll show you the kind of the settlement statement and the checks here as we go. The ARV, which stands for after repaired value. So defined, and how I was taught this, and this comes right from Ron LeGrand, is the after repair value is what would the property be worth if it was totally fixed up, ready to move in, kind of to the nines, if you will. So we're looking for the high comps in the area. Got to be apples to apples. Has to be a relatively close time frame for the sale date recently, and obviously beds, baths, square foot, the whole 9 yards. But at the end of the day, the ARV is what would it sell? What's kind of the top price that you could get for the property? Now, we're not a wholesale outfit, so we obviously are going to be retail sellers, so we're always going to be selling at the top of the market. So the comps supported a $230 on this property all day long. And I would tell you, Michael, if we ended up going for the full rehab and actually selling it, and particularly if we're going to sell it on a term sale, we would probably have that at $239.9. Obviously pricing a little bit high, not only to reflect the time for the buyer to have. In our world, our buyers typically take 12 months or so where they make payments and ultimately will pay us off at the end of the term with a loan. So we kind of lock them in the price today for a price that really won't be recognized for maybe a year down the road in their world. Plus, you always start a little high, assuming that you're going to get an offer that comes in on the property. So, but the true ARV was $230,000. Now, we bought at $130. There's a $100,000 gross margin there, and those are accurate numbers. But it needed 40 grand in repairs. And so 40 grand in our world, when you're an investor, when you're rehabbing properties that are of this price range, that gets you a long way. Now, I get that there's people watching this that are going to put a kitchen in for 40 grand or a bathroom in for 40 grand. But in our world, when you're doing an investment property that's about a $230,000 home in Jacksonville, Florida, $40,000 gets you a really, really full rehab. So there were majors in there. And again, that to us was a pretty big rehab. So these are the initial numbers, and these are what we looked at and what we utilized to put the deal together.
Fantastic. So you got the lead in, he calls you back, time and circumstances have changed. That's often the case in real estate. It's all about really just building up that pipeline. So whether it's this lead or other leads, they're going into your system, you're doing the follow-up calls down the road. Time and circumstances may change in the world, and they may ultimately call you back, which was the case here. So at that point, you've negotiated the price. He wants all cash. Where do you go from there?
Yeah, so we love the fact that he called back, and obviously we were excited about the deal no matter what. But giving us having the ability to pay cash for it and letting us actually take title to the property allowed us to really take the deal and really make the long dollar on it, which was part of our excitement. So when we put it under contract initially, and the seller actually accepted the terms deal at the 150, we started putting some marketing out there, and we got tremendous interest. So right away, we knew that we had what we thought was a winner property, just based on the interest of the general public right when we started marketing. And so now that we had the ability to put some renovation dollars into it, we tweaked some of our marketing, and again, had kind of a tremendous response. And so here's really I guess the meat and potatoes of the deal. So what we did is we ended up realizing that we thought we could sell it on what's called a work for equity. And very simply put, work for equity simply means that I will sell the house to you for a little bit less than the full ARV and give you the ability to put some of your own money into it. So you've got to do the work in exchange for you doing some work. Mr. Buyer, I'm going to give you some equity off of the price of the property. So they're really building their own equity. They're creating and adding value by doing work themselves. And by the way, when they do the work themselves, they can do it the way they like to. They can have the color choices they want to. They can make sure it's done the right way. And there's certain ways that we have that we govern that. We have a check and balance system. So we don't just put a buyer in there and say, hey, go ahead and do a full rehab on the house and let me know when it's done. We obviously have a very much a collaboration. There's a back and forth. We have a check and balance on when the work is going to be done and what they're actually doing. But at the end of the day, it can be a very appealing sale for a buyer because they get to come in, they get a discount on the price, and they get to do it themselves. And again, you get a lot of folks that are handy to a large degree, and they question maybe a contractor doing the work. In this case, they get to do the work themselves. And ultimately, our buyer, by the way, is a general contractor, specializes in flooring. I mean, this was right up his alley. He didn't want us to do any more work than we had already done because he wanted to kind of take it the long dollar. So knowing the interest and knowing that we actually had identified a buyer up front, these are the terms that we structured. So we paid the 130. That was our actual acquisition.
Let me just dive in on a couple of those before we hit the whiteboard here, Scott. So as far as the marketing goes, can you be a little bit more specific about that? So let's say that our audience, they find one of these deals, what are they marketing? Where are they marketing? And what are they saying? How are they getting that message out there?
That's a great question. Kind of the very basics. So first and foremost, we put a sign in the yard, and I smile when I say that, but signs in the yard are really our third highest way that we sell and how we market. So this house happened to be on a fairly busy intersection, or at least area of town, so we had a fair amount of drive-by traffic. So the signs, and we actually had a couple special signs made. You can get corrugated signs for $10 and with a stake, and we had a couple different ones, welcome home, and it was really kind of neat how we had put it together. Very basic stuff. We also will create, obviously, a profile page on Zillow for the property, and then we will also post in places like Facebook Marketplace, on Craigslist, and there are some other sites that get kind of auto-populated when we publish on Zillow. And by the way, controlling Zillow is always really important. Obviously, when you're buying them for cash, you become the deed holder, and therefore you have the full control of Zillow. But that's always something I want people to know, that having the ability to control the Zillow ad, whether you're entitled or you just have a contract to buy it, is really important, because most people will look at the house, they may look at another ad that you have on Facebook Marketplace, they may see a sign, and ultimately they go home and they Google the address. Well, what's the first site that pops up? Usually Zillow. If you have the seller's contact information there, they're going to reach out to the seller if you have a contract to buy it and haven't closed yet. So it's always really important to get your hands on the Zillow, on the Zillow ad itself. So as far as what we said, this was an opportunity that you could not have to qualify with a bank today. So that's always a big deal for us. There's no bank qualifying. There's easy terms, in this case, that you can buy with equity if you do it yourself. So work for equity in the real estate world is actually a fairly well-known phrase, and people understand the merits of that they can come in and typically get a better buy on the property. So our marketing was just one of the things, you got to just show up. You just got to be out there. It's never going to, doesn't have to be perfect. Rarely is the marketing ever perfect, but it just has to have the message and the fact that there's an opportunity here. So lease to own is always in our headlines. We always let people know that you can buy this property on terms, lease to own, lease purchase. There's phrases that we'll put out there. And of course, having kind of a mixture of those ads. So we have typically 4 to 8 different ads that we create for every property we have. And we're always rotating them so we can be kind of at the top of the postings in Facebook Marketplace or on Craigslist. And we always want to make sure that we have kind of multiple messages, because you never know what message is going to catch a potential buyer. So those were kind of the phrases and the kind of the approach we took for the marketing.
Yeah, I love that. So, everyone that's watching, those are tidbits, guys. So all of the marketing, or for the most part, the marketing that he just mentioned for this house to make a $60,000 profit on it, the sign, he talked about maybe $10 in the front yard, some Zillow, just a Zillow ad, which is free. You're basically just taking over an existing ad in many cases. Craigslist, small amount of money to set up an account, and then just really staying on top of that. There's small costs associated with some Facebook marketing. Facebook Marketplace as well is relatively inexpensive, if any, in many cases. So you don't have to throw thousands of dollars into marketing these houses once you get them under contract. Of course, if you're part of Pink and Scott's business model with corporate, these are all templated. You're plugging right in. You're getting access to marketing that already exists. You're simply changing out the subject property. For those of you at home that are going to be doing this on your own, that kind of DIY, these are nuggets that have been learned and are tried and true over the last handful of years. So you don't have to have some sort of robust marketing budget for these. Get the house under contract. Love the work for equity. Also have done a ton of those over the years. You guys nailed, obviously, the perfect buyer. You're looking for that kind of handyman. You're looking for that, kind of GC that wants to go in there, not only do it themselves, but they ultimately want to save a lot of money. Not only is that great for them, it's great for you too, because you don't have to get involved in that rehab process, which there can be a lot of hair on that dog, as we all know. We've all got horror stories with that. We're not going to go down that rabbit hole too far today, but appreciate you sharing that. So the buyer comes in off the marketing. Take it from there.
Yeah, and I just want to tie that down one more time. When you have a property, you just got to get the exposure. You've got to get out there. Don't overanalyze it. Get 4 to 8 different ads, different buzz phrases that can attract different buyers, and get them out there and post them and repost them and refresh them. And you've got to be, kind of one of our phrases here, you got to be at the trough. If you want to eat, you got to be at the trough. So just getting out there is paramount. Don't overanalyze it. Don't think it's got to be perfect. Don't worry if the pictures aren't perfect. Obviously, all that stuff, the better you can get, the better likely your marketing is going to look, and hopefully the quicker you attract a buyer, but don't get hung up on it. So anyway, ultimately, please.
No, really astute points that you're making there. Guys, if you're watching this right now, you're interested in deals like this, you don't want to go it alone. You don't want to do it by yourself. You want to make sure you've got that structure and a support team behind you. Go ahead and email pink@vipfinancialeducation.com. That is pink, like the color, at vipfinancialeducation.com. Include your first name, your last name, the best number to reach you at, and include Pink Conversation in the subject line, and someone will get back in touch with you with additional information, making sure that your market is still available. So Scott, really, I'm eyeballing. I've got some drool coming to my mouth looking at that whiteboard right now. So I'm a whiteboard junkie. A ton of people on our audience are, and our audience are as well. So love the whiteboard series here. So keep those coming.
Absolutely. So yeah, we love them too, and especially when they look like this. It was a good deal. We like it. So we have a buyer shows up, and we had kind of our work scope mapped out. So we got full bids. We knew what it was going to cost, obviously, to do the full scope rehab. And you made a great point there that I'm going to come back to in just a minute, because when you do work for equity, you don't have to do all of the work. You don't have to have a contract to do all the work, and there's a value associated with that, right? So just the headache or lack of headaches and the time factor. When you do big rehabs, you have obviously a window of time that they need to take. In this case, this was probably going to be a 60 to 75 day rehab, just based on the different components that it required. And by selling it work for equity, we didn't have to undertake that. And what's beautiful, and I'll show you in the end here, is the amount of money that we made. We were able to make the same amount without having to do the work. So in some cases, if you discount the value to let somebody take it work for equity, you may not make as much. But in this case, we're able to structure restructure the terms and conditions and ultimately the sale price to our favor, to where we actually made the same amount of money. So we plan to try to sell it work for equity. We're going to do some things. You pick up the yard. In this particular case, the house, just the outside, just picking up the house, cleaning up the yard, cutting back some overgrown bushes, and there's a branch hanging over one of the front windows, and just making it look a little pretty. One of the couple fence panels had fallen down, and it just was, you could tell the house was neglected. It just hadn't been taken really good care of. It wasn't beat up, it just needed some attention. So just doing some things to the outside, freshening it up, and ultimately having a couple really friendly signs that kind of lead people in was a great starting point. And so you do those things first, you get some interest, and particularly this case with the people driving by it. And so we had somebody show up, and we discussed kind of the work that we had planned to do, and the fact that we would have the ability and the interest in selling it, leaving some equity on the table, and ultimately letting the buyer take the property for a lesser value, doing the work themselves, creating value, creating equity by doing the work themselves. So here's what we did as far as the numbers are concerned. We actually borrowed on the property. Again, OPM, that's always the case, is you use other people's money when you're buying these deals. We borrowed $160. So we borrowed $160 on the property. We negotiated the fact that we were going to do about $10,000 in rehab. And let me give a quick tidbit on that. When you're selling on work for equity, you want to, my advice to you is to make sure that you take care of the major mechanical systems. Everybody's kind of a Home Depot warrior nowadays. Everybody can paint, everybody can do drywall, or at least most people. Flooring is a possibility if people want to replace cabinets. Those are cosmetic type improvements. When you're dealing with an electrical issue or electrical panel issue, or the heating and air, the HVAC, the roof, if you happen to have a septic system, if there's plumbing, the water heater, those are kind of specialized contracting areas, and in many cases require licenses, and in some cases will require permits. So what I've learned for work for equity is that if you rely on a buyer who may purport to be a handyman, and in many cases they are, but letting them do the mechanicals, to me, was always, I was always taught that you do the mechanicals, let them take the cosmetics, and ultimately you can feel good that somebody didn't wire the house incorrectly and either burn it down, God forbid, or when they get to the time where they have to go, they being the buyer, go get a bank loan for the property, it doesn't inspect. Okay, it doesn't pass the inspection because they didn't know what they were doing, and they hodgepodge the electrical, and now you have a bigger problem, and you could have addressed it up front. So we ended up spending 10 grand on repairs, and almost all 10 of it went to the mechanicals, to make sure the mechanicals were in good working order. The balance of the other work that the buyer was going to do and is going to do is really cosmetic, and it's right in his wheelhouse. So we feel good about the mechanicals because now we know they're not only in perfectly functioning order, they're all up to code, they're all upgraded and in great working condition. And by the way, I got to give one other tidbit. We're in Florida, and I'm not trying to make anybody jealous, but it's 80 degrees out today, and it happens to be right in the middle of January. So they're not saying that up north. And Michael, we're both from up north, so we know the pain that early January can bring. If you have a house that you're looking at, and particularly if you live in the north or where it's colder and really cold in the winters, it can freeze, and the house hasn't been lived in, and no one's been living there for a period of weeks or months, you have some potential red flags with the mechanical systems. And so I've seen houses up in Ohio that have actually, the winterization has actually frozen. So they did the winterization wrong, and ultimately the toilet bottom froze through, and the water heater. So when you're looking at properties in the wintertime, it's always good to know if somebody's lived in them recently, how recently, because the mechanical systems are working. If it's been empty for a period of time, you definitely, and you're in the cold weather where it's freezing, you want to just make sure that something that you cannot see, like a plumbing pipe behind the wall, hasn't cracked in the process of not being utilized, through the winter months. And so in this case,
that's a great trade secret. That's stuff that just, kind of the novice or the beginning investor just, it wouldn't occur to them. So just great value right there even.
Well, thank you, and I'm smiling because I've had a couple of those hard-fought lessons, right, where we make offers.
You learn the best lessons the hard way, right?
I tell you, right, and you smile.
Trying to make sure that the people watching us on here don't have to make those same painful lessons. So appreciate you sharing that.
Yeah, no, that's exactly right. And I say I'm smiling now. I'm sure I wasn't smiling at the time, right? You make an offer assuming that the mechanicals are in good working order, only to find out that they're not, and now it costs you more. And so smiling now, but hopefully they folks watching can avoid that lesson. So anyway, so I feel really good about what we did on the property. We've got 10 into it, and remember the ARV, Michael, was 230. So fixed up, ready to go, all the way, move in, really a beautiful home, full renovation would be $230. We sold it to our buyer on a work for equity for $200,000. So we left 30 grand on the table, and I got to tell you, that's a lot of money. Now, if our rehab costs were 40 and we spent 10, there's still 30 in rehab to do. So in some ways you could argue it's a wash. Now, can this particular buyer get it done for a lot less than 30? And the answer is yes. You pay a lot of labor when you're doing rehabs. In fact, we always break down labor and material. And that's another little tidbit. If you're doing a rehab, have your contract. Most contractors will just give you the bid. Yeah, it's $40,850. It's always a weird number. But what's the breakdown of the labor costs and the material? And that's where you try to keep them a little bit honest, because now they have to tell you how they're coming up with their number and what portion of that is going to be labor. Let me tell one other thing. This is something I learned a long time ago. And this is another way people can get stung when you're doing rehabs. Contractors will show up, they want 40% on the first draw or some big number. We never give that. We'll give a fair number based on the material costs and the labor costs that they've said they need to get started. We typically would say, okay, look, these are the 5 things you're going to do in these next 7 days. When you have these things completed, call me. I will come out. I'll sign off on them, at which point we'll authorize your next draw. The next draw will be predicated on the next 5 items on the list, material and labor costs, right? Keeping them honest. And I will release the next draw after you get these 5 things done in this 7-day window. Call me back. I'll come to the house, sign off on it. What happens too often, Michael, is people get comfortable with their contractor, they get familiar with them, they trust them, they don't trust them, the contractor is a good talker, whatever the case is, they start releasing draws bigger than they need to or probably should without checking and balancing the work. So that's how people can really get stung in rehabs, and that's a really simple way to check and balance the contractor. Just a quick FYI there. So
there's no better way to lose motivation as a contractor than when you've already been paid on a job, right? You start opening your eyes to additional jobs that are out there. You're at that point, the person writing the checks is really beholden to the contractor that the money has already been released. So fantastic point. Guys that have not rehabbed, people that are rehabbing that maybe have been stung by that in the past, that is sage advice that Scott just delivered here on that with that message, guys. So pay close attention to what he's saying here. That's we've all been burnt, and the way Scott is telling you to kind of parcel out that the money for the contractors is absolutely brilliant.
Yeah, we've been there, and yeah, that's an easy way to get stung. And by the way, I had lunch with LeGrand last week and was sharing out how he had gotten stung in some of his earlier days because he had a contractor that he just got comfortable with and was doing multiple houses and stopped checking and balancing. And human tendencies take over, you get comfortable, the contractor gets comfortable, and then you cut too big of draws. And next thing you know, Mike, that's a great point. The minute you cut them the check, at a certain point in the renovation, although I could argue doesn't matter when you cut them the check, there's an element of being beholden to them because you just gave them obviously a large draw. And yeah, there's no lesser motivation for a contractor than when they've already been paid, and they've got another job that they can get another draw check on. So yeah, that's a very, very good point there. So okay, let me just kind of tie this down. So we had sold the house at $200,000, work for equity. We do have a work scope with our buyer. So the same thing that I just said about the contractor, we are doing the same exact thing for the buyer. So I want to just kind of pause for purpose on that. When you're doing work for equity and you're having a buyer do the work for a discount on the price, so they're getting the ability to create value, create equity by adding the work that they do, you should have the same exact check and balance with your buyer as you do with the contractor. Now, a buyer that lives there and works a full-time job isn't going to be obviously able to work on the property full-time for 3 weeks or however long it's going to take to get the job done. So you've got to have a little bit more of a lax schedule. So the first 5 items on their checklist, now we're not releasing draws here, but we want to make sure they do the work. Ultimately, we want them to do the work. That's why we discounted the property, the price on the property. So in this case, we have the same 5 items. In this, we have a little bit of a longer window. Instead of 7 days, we have maybe 30 days because the buyer has to move in, and obviously they still have their life. But we then will come and check after they've let us know that the work is done, so we can verify that it's been done, and of course verify that to some degree it was done the right way. So ultimately, there's a lot of similarities there, and we treat the buyer, let me say that we structure the buyer really the same as we would structure a contractor with that check and balance and what we call a very simple work scope. A work scope that has the items that to be done listed out, and then just broken down typically in increments of 5. Kind of easy, not overcomplicated, very simple for everybody to understand. So, okay, so if you're looking at the numbers, you're seeing that we borrowed more than we would need for the rehab, thus the title of the video or the training, OverFi. It's just a great strategy. So let me tell you what happened. So if we borrowed 160 and we paid 130 and we put 10 in it, we put 20 in our pocket. So 160 minus 130 is $30,000 minus $10,000 for repairs that we did. That means we put $20,000 in our pocket when we closed it. And I've got a copy of the check here. So the old buy a house, get a check. We closed this deal. It was the 2 or 3 days right before Christmas. And ultimately we put $20,000 in our pocket from the overfinance. Now, that money is tax-free. Took me a minute to figure that out. It's tax-free because it's a loan. You borrow the money, you're paying it back. So therefore, the money you put in your pocket from the overfinance is non-taxable income because it's a loan that's going to be paid back. The beauty is our buyer who's making payments to us will then, that payment goes out to offset the payment we have to our private lender here. So the payments ultimately are going to get paid back, and the loan's going to get paid back, I should say, by our buyer. So number one, buy a house, put 20 grand in your pocket, and you own the property. I mean, it's about as beautiful as it gets, right? That is really the rub right there. Now, you don't have to borrow 20. I've seen people try to suck out all the juice in the deal. You know, there's a certain loan to value ratio that you'll need to honor. And in this case, we were really able to do that because we made a good buy. But we look at deals like this all the time. This is not, listen, we'll take these every day of the week, but these are in every market around the country. You just have to know where to look. And you have to know how to structure it so it can be attractive to not only you, but your potential lender and obviously your potential buyer. So we put $20,000 in our pocket at the day that we closed it, right before Christmas. It was a nice little hit before Christmas. We are closing our buyer in 2 days. This Friday at 4:30, we're closing our buyer. They're putting $18,000 down. So they are buying it at $200 on a work for equity with $18,000 down. And what's great about this buyer, this couple, is he not only is a handyman, but they actually have really good credit, and they are only needing 6 months before they can get a traditional loan. So just like we always do, Michael, we take them through our normal vetting process. Anytime we have a buyer that wants to buy one of our properties that is not paying cash or getting a bank loan today, we will sell it to them on terms, typically a lease with an option to buy. How we qualify our buyers is different than anybody that I've ever seen, any other outfit similar to ours. I've never seen another real estate investment company qualify the buyer the way that we do. We take them through underwriting just like Bank of America. We have a company we work with, actually have 3 companies we work with now, that run them through the underwriting process identical to Bank of America, Chase, Wells Fargo. We just understand they're not going to qualify today, so we're not looking to see if they qualify. We're looking to see why they don't qualify. And from that vantage point, we will then put together, I say we, it's this third-party company, a blueprint or a roadmap, as we call it, to their successful home ownership, which means their successful financing. So over the course of the next 6 months, this couple is going to be doing work on the property. We're going to hold them, obviously, to the work that they're committing to do in that work scope that we've put as part of their agreement. It's an addendum in their actual purchase agreement with us, their lease option agreement. And ultimately, they only need 6 months to get a loan. So we put 20 in our pocket the day we closed it. We're putting 18 in our pocket from the buyer's down payment on Friday. And if you're doing the math, that means there's a $22,000 back end. So when our buyer goes to get their loan in 6 months, what they owe us and what we owe our investor, there's another $22,000 there. So when they go, we'll have a couple bucks in closing costs, to be fair. But at the end of the day, we're going to recognize a $60,000 gross profit on the deal. And we didn't have to do all the work to recognize it. So the numbers to me are great. You make money up front when you buy it. You make money during the term. The buyer ultimately pays the loan that we have back, and we have a nice little spread at the back of the deal. So we'll pick up another nice check along the way when the buyer cashes out. 6 months later, the investor had a good experience. They want to go do another one, so we roll it into the next deal and do it again. It's kind of a rinse and repeat process. So a couple different components here. The overfinancing was really the highlight I want to share. Most people don't look at it, don't think about it, don't know that it even exists, but I got to say it again. I know you guys at VIP, Michael, have done a lot of videos on the HELOC and how to utilize your home equity line of credit for opportunities to buy other investment properties, right? It's the same thing. This isn't your personal residence. You don't have to go get an equity line. You have one loan, one investor, and you get to recognize the same benefits of the equity in the property, and you can go take that 20 and go put on a down payment for another property if you want. So the principles are the exact same. It just is a little bit different from an investor standpoint. So that's the deal as a whole.
No, love that. Obviously, there's some really, really technical aspects of this deal. Some of the dots will continue to connect. Those of you that are interested in really kind of a hand-holding and that intimate training and being a part of an organization that's going to help you take these deals down, go ahead and email pink@vipfinancialeducation.com. Include your first, your last name, the best number to reach you at, and Pink Conversation in the subject line. Someone will get back in touch with you to talk about that opportunity. If you're not interested in getting involved in Pink and you want to DIY, you want to take these strategies and you want to be a sponge and you want to go out there and implement it yourself, Scott, you mentioned a couple things as far as the structure that Pink brings to the table. If you are, just want to kind of be that mom and pop and that DIY individual, how do you take down the financing? Obviously, you're going to go out and find your private money lender. We're going to be bringing one of those here on the channel, so stay tuned for that. You've got your money lined up from one way or the other. As far as, would you recommend them develop a relationship with a mortgage broker, with a credit repair specialist? What ingredients do they really need to bake in to their strategy if they don't have the resources already built in with a Pink, for example?
There's really not a lot of complicated things here. It's just different than most people are accustomed to. But it's a really great question, and I've got what I hope is a really great answer. So people that want to do this on their own, first of all, you've got to start generating leads, and that can come in many, many different ways. Contacting realtors that deal with distressed properties is a great starting point. A lot of people that have a distressed property, first place they go to is to an agent to list it. So finding realtors that kind of scour the MLS is a really good starting point. There's also realtors that specialize in selling foreclosed properties. So those are called REOs, or real estate owned, and every lender, or at least mortgage lender, note servicer, has an asset manager that is responsible for kind of the disposition of the properties they take back, and they typically have realtors in every city that they identify and that they end up listing most of those properties with. We just found this one online. So just if you're looking online, there's just deals out there. You just have to look. You have to be at the trough. So you've got competition out there. People are looking online as well. You just have to be out there looking. So getting the lead is number one. But the other part that I think is going to be a really, really big takeaway here is this. Private lenders are in your circle right now. You just don't know it. So this is an opportunity for someone who has some money, and obviously there's several infinite fields that can really generate a lot of money. Of people that have a lot of money that are making very small return, whether it's a savings account or money market or whatever it is. In this case, we're paying 12% interest. So that's high interest on it, but that's very normal for a private lender. For using OPM, we have no money out of our pocket in the deal, so we have no risk at the end of the day, if you will. We have a loan on the property. They're collateralized. They have a first mortgage, they have an only mortgage, and obviously a property that's worth a lot more. So we're able to pay them a nice rate of return because we're not even really paying it. Our buyer's ultimately paying it, and this is just a 6-month term. So we actually talk a lot with our folks about how to find private lenders. There's people in your circle right now that if they could have a safe, secure, collateralized way to invest in real estate, kind of help you out and make some money at the same time, the way that we teach people how to structure it can be really attractive and can be really safe. And let me take it one step further. I never touched the 160. I never laid my hands on that. That goes right to the title company. The title company, the investor wires in the title company. They take care of the closing. They actually cut us a check back for the difference. And so we don't touch the big money. It's wired in. It's all handled by a title company. They draft the mortgage and they record it. They make sure everything is done properly. So this can be done by anybody. There's people that like to work with us. There's people that like to do it themselves. Starting point, as you are generating leads, and you need to start looking at leads now. You start looking. But you also want to start cultivating relationships that are in your circle right now. An uncle or an aunt, your dentist, the chiropractor. I mean, there's people that really are in your circle right now that you don't even know exist that might be a good lender for you. One of our affiliates the other day was at a Christmas dinner party, and turns out the brother-in-law, who he wasn't too close with, had some good fortune recently, and they started talking about what he's doing, and he now has committed to put money up for the next deal that our affiliate's doing. So But knowing what to say and how to structure it and how to speak intelligently, again, it's very, very simple. We're big believers in keep it simple, silly, but you have to be able to speak intelligently, obviously know how to structure the deal. So my advice for people wanting to DIY it would really be those parallel tracks. You'll find buyers, you'll find mortgage lenders to work with your buyers, but what you need right now is to start looking at a lot of leads, and obviously we have several ways that we generate leads, but you also want to be looking for somebody in your world that would like to make a nice rate of return, ultimately help you out and make a couple bucks along the way. There's a way to do it where it's a safe, it's a collateralized the right way. The loan to value is a very conservative loan to value ultimately, and ultimately it's a positive for everyone involved. Having private lenders in your world allow you to go out and make cash offers, and those really are where you can find some gems and really find some big equity deals like this one. That would really be my advice for starting points for the DIYers.
Yeah, no, love that advice there. Yeah, you've got to have the money, obviously, to get involved in deals like this. Obviously, we're going to be featuring other creative strategies on the channel here with Scott here on the whiteboard, breaking them down. There are plenty of no money, no credit investment strategies out there as well that are part of this kind of Swiss Army knife approach, where it doesn't matter what deal's coming across your desk, guys. If you're working with Pink, obviously, we're coaching and training you and locking arms to get those deals to the closing table. If you're doing it on your own, we're going to give you as much content, as much value, and as much education on these videos as possible so that you do have the tools, and at least it's on your radar. So now people are familiar with an OverFi strategy. Maybe they weren't before, maybe they were. Obviously you've shown, you have shined a lot of light on this particular strategy. I love it. 60 grand, obviously in and out on a deal like this, 6 months or less, you get your entire profit recognized on that. So absolute slam dunk. If people are thinking about coming on board with this, we always kind of try and paint the flip side of the coin. Obviously, this was a success story. Who should not get involved in deals like this? What are some of the perils that are involved?
It's a great question, and let me kind of preface, if I may. In this case, and I'm going to answer the question in just a second, we had the ability to borrow the $20,000 above what we needed for the reasons that I already shared. I won't repeat myself, but even if you don't have the ability to borrow 20, one of the things I was taught early on is that when you're doing a rehab project, from the time you find the deal to you negotiate to you close it, you meet contractors, you oversee the renovation, you might have multiple contractors doing multiple things, right, mechanical systems, and you can hire a general contractor and they can oversee the job, but that obviously is going to cost more, and you can also have different contractors that you oversee, and it just depends on the job as a whole. But you have trips back and forth, you have time spent, you have energy spent, you have gas money spent. Then you have to identify a buyer through your marketing. So you'll be putting signs out, you'll have showings, and all that stuff is part of the process. It's a lot of fun, and it's a lot of fun. But when you're not getting paid for, let's say, 3 months, if you did a full rehab and you've got a long rehab and it's going to be 3 months till you get it done and ultimately sold, for that window of time, you're kind of working for free. So I've always been taught you should at least borrow $5,000 above what you need for the purchase and the renovation that goes in your pocket at the time you buy it, so you have the opportunity to have at least some spending money in that window of time that the process of the renovation is going on. Just a tidbit that I want to share because I've seen it benefit. It can help morale. It can help kind of your excitement for the deal. Dealing with contractors isn't always the easiest thing in the world. It's not rocket science, but it's what it is. And so not having any money from the deal until, it's all said and done can be challenging in some cases, especially if the rehab goes longer. Of course, rehabs always come in on time. They come in under budget every time. There's no cut corners. Oh, wait. Sorry, I had something in my mind there.
Every rehab I've ever been a part of has gone just perfectly.
Perfectly, yeah. Right?
I hear all these horror stories out there. None of them have ever happened.
I was like, man, how lucky are we? All these horror stories happen to other people, but not us. I mean, it must be something that we're doing right. So
no, I love that. I love that strategy to get paid up front. Guys, you're not going to always be able to recognize that $20K up front. It's obviously going to depend on a number of variables that Scott has really illustrated well on the whiteboard here today. But getting something up front, over borrowing even that $5,000, like Scott said, that can even just really help your morale out. If you're chasing, this deal and doing all the work for, multiple months in a row and you haven't seen any of the fruits of your labor, it can in some cases be a little bit discouraging. So love that strategy. Make something up front. It's not always going to be 20. Try and build in at least 5 though on every deal that you do here, guys.
Look, and let me just answer that question if I may, Michael. Who's this not for? Look, you have people that watch that want to be hands-off. They want to be passive. They want to maybe own rental property, Airbnb. Obviously, those are long-term and well, short and long-term, but some great strategies and great long-term wealth, and have nothing but praise to heap on those strategies. Those, in many cases, can be more passive. This is going to be a little bit more hands-on, and I guess, you know, you have to have, I guess, a little bit of chutzpah to make the offer. One of the things I learned early on is when you're making cash offers, if you're not embarrassed by your offer, you're probably offering too much. So be embarrassed when you make your offers.
Your first offer, you've definitely left some money.
I mean, yeah, right. You definitely paid too much. So, but you know, you've got to have, I guess, a little bit of hands-on here, and you know, not be scared to go to the property and oversee contractors, and ultimately kind of oversee the deal. And just from experience, I've had the privilege of getting to work with literally thousands of people across the country, not just with Pink, but with LeGrand and some of my prior experiences. And I've seen all types. There are some that love this stuff. They can hop right in. They got no issues, you know, making offers and overseeing renovations and doing work for equity type sales with those types of buyers, and it's just in their wheelhouse. And I've also seen others that they love real estate. They want to invest and love to invest in many cases, but that's not really their shtick. That's not really their personality. It's not really what they want to do. They don't like people. They don't want to deal with too many people, and believe me, I get that. But so I would say that this would be for the investor that's ready to be a little bit more hands-on. This would not be as passive. Now, I don't want to pretend like this is a ton of work because you're not really overseeing the full rehab in a work for equity case like this. And frankly, you can do a lot of these types of deals and manage them with relative ease. But it does take a certain personality. And so I would say this would not be for the truly passive person. This would be somebody that wants to be a little more hands-on and that has a little bit of that fortitude to get out there and be able to oversee, you know, some contractors which have their own personalities and obviously their own, you know, sets of challenges that come with doing the rehab. So I won't want to scare anybody, but that would be my advice for the type of person that would be looking to do these types of deals.
Yeah, fantastic. We always try and paint the good, the bad, and the ugly. Obviously, every deal is going to have could have some potential drawbacks to it. You know, it's not always going to be the right fit for folks. We're always going to encourage people to go out there and do their own research. You're probably not going to find a ton of information on overfinancing or OverFi deals out there, because like we've talked about on this video, it's fairly uncommon. We're going to continue to bring videos like this on. We're going to continue to bring Scott back here on the channel, assuming he continues to give just great educational content like this. Guys, if you're interested in Pink, you've got the email. Go ahead and reach out. If not, just be a sponge, absorb these videos. You're going to get enough content on these. If you do want to have that kind of DIY approach to this, we're going to give you the tools to be able to go out there and implement. Guys, if you want more content like this, go ahead and smash that thumbs up below. That lets us know we're on the right track. We'll continue to bring special guests and experts in their field, like Mr. Scott Ulmer in real estate here. We love bringing real estate on, but go out and do your own research in advance as well, guys. If you're a subscriber already, thanks for joining us again. If you are not, go ahead and subscribe. We're going to keep bringing content like this here on the channel. And go ahead and ding that bell notification below. That's going to give you the heads up when we release new videos like this on the VIP Financial Education YouTube channel, where we talk about all things credit, capital, and cash flow. And until next time, guys, take care and make it a great day.
Some names and where you're from.
Bobby and Jenny Witten. We're from Knoxville, Tennessee.
What's your previous real estate experience?
So we've got some buy and hold properties. We currently have about 7 units, and we've been in real estate investing for about a year now.
Fantastic. After the last 4 days, what's the biggest takeaway?
The biggest takeaway from us is this is something you don't have to do alone. The staff here is incredible. They're supportive, they're knowledgeable, they're friendly, professional. We don't feel like we're doing this alone. We feel like we've got a team behind us, and that's going to make all the difference.